2025 looks like 1929, the year before the Great Depression, the year of peak optimism before the longest economic collapse in modern history, the year when everyone believed the party would never end. 2025 also looks like 2008, the year of the global financial crisis, the year when the housing bubble, subprime debt, and over-leveraged banks brought the entire system to its knees, the year when too big to fail entered the American vocabulary. But here's what should terrify you. We're not just repeating one of these disasters. We're repeating both. Simultaneously, the warning signs from 1929 are present. The warning signs from 2008 are present. And we have a third crisis neither of those years had to deal with. Why will 2025 to 2030 be worse than 1929 and 2008 combined? We're going to examine the exact patterns that preceded both crashes and show you they're happening right now. And we're going to demonstrate why this time, when it crashes, there's no way out. This is not prediction. This is pattern recognition. The same instruments that flashed red before every major crash in the last century are flashing red again. All of them, simultaneously. Three bubbles, all inflating together, all crashing simultaneously. The first bubble is stocks. The S&P 500 P/E ratio sits at 30.42 as of November 2025. The Shiller-Cape ratio is 38.7. The Buffett indicator, Warren Buffett's favorite valuation metric, which divides total market capitalization by GDP, is at 209%. To put that in perspective, the historical P/E average is 15 to 17. The ratio has only been higher twice before, in 1929 when it hit 32 and in 2000 when it hit 44, both right before massive crashes. The Buffett indicator peaked at 140% before the dot-com bubble burst. At the 1929 market peak, it was 209%. We're there now. Right now? In November 2025. The concentration risk is staggering. The Magnificent Seven tech stocks, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, make up 30% of the entire S&P 500. If Nvidia, Apple, and Microsoft correct, the entire market follows. This is the exact same concentration we saw in 1929 when utilities and railroads made up 40% of the market. The AI hype is electricity hype all over again. In the 1920s, they said electricity will change everything. In the 2000s, it was the internet changes everything. In 2025, it's AI will change everything. Same narrative, same mania, same crash pattern. The second bubble is real estate. Residential real estate is currently overvalued by 50% above the long-term trend. In 2008, at the peak before the crash, housing was 35% above trend. This is 43% worse than 2008. Commercial real estate is in free fall. The office vacancy rate hit a record high of 20% in 2025. Class B and C office buildings are over 23% vacant. There's $1 trillion in commercial mortgages that came due in 2024 and 2025, with hundreds of billions more maturing through 2026. The default rate on single-asset commercial mortgage-backed securities is 8.7%, nearly 3 times higher than 2022. Regional banks hold massive commercial real estate loans. As these loans mature at higher interest rates, banks cannot refinance them. This is similar to the toxic mortgage holdings in 2008. But the concentration is worse because these banks are smaller and more exposed. The third bubble is sovereign debt, and this is critical because neither 1929 nor 2008 had this problem. Total U.S. debt surpassed $38 trillion in October 2025. That's now over 130% of GDP. Annual interest payments exceed $1.2 trillion, which is approaching 40% of tax revenue. In 2024 alone, the U.S. added $2 trillion to the debt, and 2025 is on track to add another $2 trillion. Compare that to history. In 1929, government debt was 16% of GDP. In 2008, it was 67% of GDP. In 2025, it's over 130% of GDP and accelerating. At current interest rates on $38 trillion in debt, interest payments are now the fastest growing part of the federal budget. Total federal tax revenue is approximately $4.7 trillion. Interest alone consumes nearly 40% of all tax revenue. This is mathematically unsustainable. In 2008, the government could borrow to bail out the banks. In 2025, the government is the problem. Who bails out the government? Let me show you why 2025 looks exactly like 1929 and then why it's actually worse. Stock valuations are at extremes. In 1929, the DJIA-P/E ratio was above 32. Now, the S&P 500 PE ratio is 30.42 and the Buffett indicator is at 209%, the exact same level as the 1929 peak. Margin debt is at record highs relative to market capitalization. In 1929, only 10% of households could even invest in the stock market. Now, margin debt is at all-time highs with far more participants. Wealth inequality is extreme. In 1929, the top 1% owned 23% of all wealth. Now, the top 1% owns 32% of wealth. It's worse than 1929. The "this time is different" mentality is everywhere. In 1929, economist Irving Fisher famously said we have reached a permanently high plateau just days before the crash. They said electricity will revolutionize everything. Now in 2025, we hear AI will revolutionize everything. And the Fed has inflation under control. Market concentration is eerily similar. In 1929, utilities and railroads made up 40% of the market. Now, the Magnificent Seven make up 30% of the S&P 500. Speculative mania is rampant. In 1929, everyone was buying stocks on margin. Now, retail investors are piling into tech stocks, crypto, and meme stocks with borrowed money. But here's why 2025 is worse than 1929. In 1929, only 10% of households had stock exposure. Now, 58% of households are exposed via 401(k), IRAs, and pension funds. When the crash comes, everyone loses. In 1929, the Fed had credibility and 5% interest rates to cut. Now, the Fed damaged its credibility with inflation mistakes and has limited room to cut without reigniting inflation. In 1929, government debt was 16% of GDP, so the government could intervene and become the solution. Now, government debt is over 130% of GDP, and the government cannot bail anyone out. The government is part of the problem, not the solution. In 1929, recovery took 25 years but was eventually possible. Now, demographic headwinds with baby boomers retiring means there are net sellers in the market, and global fragmentation means recovery could take even longer. Now let me show you why 2025 also looks exactly like 2007 and why it's worse. Real estate is overvalued. In 2008, housing was 35% above the long-term trend. Now, housing is 50% above trend, and commercial real estate is crashing simultaneously. Subprime debt has been repackaged. In 2008, it was CDOs and mortgage-backed securities. Now it's collateralized loan obligations and covenant-light loans. The debt didn't disappear. It was renamed. Credit default swaps are back. In 2008, the notional value of credit default swaps was $62 trillion. Now, the derivatives market exceeds $600 trillion in notional value. Bank exposure to bad assets is widespread. In 2008, regional banks were holding toxic mortgages. Now, regional banks are exposed to commercial real estate loans and long-term treasuries that have lost value as rates rose. The contained narrative is identical. In 2007, Fed Chairman Ben Bernanke said, "Subprime is contained." In 2023, Fed Chairman Jerome Powell said regional bank issues are contained. It's the same script. The yield curve inverted from 2022 to 2024, one of the longest inversions on record. It uninverted in September 2024. Historically, recession comes 3 to 12 months after uninversion. We are inside the window right now. November 2025. We're here. Consumer stress is mounting. Credit card delinquencies are at the highest levels since 2009. Auto loan defaults are rising. The consumer savings rate is near zero. Insider selling reached panic levels throughout 2024 and into 2025. Warren Buffett's Berkshire Hathaway is sitting on over $347 billion in cash as of Q1 2025, having sold over $134 billion worth of stocks during 2024. Buffett dumped half his Apple position and sold Bank of America. He hasn't bought back Berkshire stock since mid-2024 despite claiming it's his favorite investment. When the Oracle of Omaha is hoarding cash at levels not seen in 30 years, you pay attention. But here's why 2025 is worse than 2008. In 2008, the Fed could cut interest rates from 5.25% all the way down to 0%. Now, rates are already at historically low levels after COVID, and inflation limits how much the Fed can cut without reigniting price increases. In 2008, the Fed could implement quantitative easing, expanding its balance sheet from $800 billion to $4 trillion. Now, QE directly caused the 2021 to 2023 inflation crisis. The Fed can't use the same tool without destroying the dollar's credibility. In 2008, the government could borrow for bailouts because debt was only 67% of GDP. Now, debt is over 130% of GDP, interest payments exceed $1.2 trillion per year, and borrowing capacity is exhausted. There is no bailout coming because the government itself needs bailing out. This is the core argument. This is why 2025 to 2026 will be worse than 1929 and 2008 combined. We have multiple simultaneous bubbles. In 1929, only stocks crashed. Bonds were a safe haven. In 2008, only housing crashed. Stocks recovered and bonds rallied. In 2025, stocks, housing, and bonds are all overvalued. There is nowhere to hide. We have universal exposure. In 1929, 10% of the population was in the stock market. In 2008, 50% had 401ks. In 2025, 58% are in retirement accounts, and nearly 66% own homes with real estate wealth. Everyone loses everything simultaneously. Policy tools are exhausted. The Fed can't cut rates aggressively because rates are already near historic lows and inflation is still above target. Cut too much and you get a currency crisis. The Fed can't do unlimited QE because it printed $5 trillion from 2020 to 2021, and the result was the worst inflation in 40 years. Credibility is destroyed. If they print again, the dollar enters crisis. The government can't bail anyone out because government debt is over $38 trillion, over 130% of GDP, and interest alone costs over $1.2 trillion per year. Who bails out the government? And demographic timing is catastrophic. Baby boomers are retiring at a rate of 10,000 per day. They need to sell assets to fund retirement. They need buyers. There are no buyers. Sellers are overwhelming the market. This is the opposite of the 1980s and 1990s when boomers were in their peak earning years, buying stocks and real estate. Now they're net sellers. Global fragmentation means no rescue. In 2008, China bought U.S. debt and helped stabilize the system. In 2025, China is in its own crisis with a collapsing real estate sector and demographic decline. The BRICS nations are creating alternative currencies and payment systems. No one is coming to help the United States. Based on historical patterns, here is the timeline. The yield curve inverted from 2022 to 2024, one of the longest inversions in history. It uninverted in September 2024. Historical pattern. Recession comes 3 to 12 months after uninversion. The recession window is December 2024 to September 2025. We are inside the window right now. November 2025. We are here. Additional warnings are flashing now. Insider selling reached panic levels throughout 2024. CEOs dumped stock at rates not seen since 2007. Jeff Bezos sold billions. Mark Zuckerberg sold billions. Warren Buffett is sitting on over $347 billion in cash as of Q1 2025, a record, after being a net seller of stocks for over 10 consecutive quarters. From October 2022 through early 2025, Berkshire Hathaway sold over $174 billion more in stocks than it purchased. Buffett's cash pile has more than tripled in 3 years. Consumer stress is mounting. Credit card delinquencies are at the highest levels since 2009. Auto loan defaults are rising. The consumer savings rate is near zero. Americans are tapped out. Commercial real estate continues to collapse. Office vacancy is above 20% in major cities. Regional banks are massively exposed. The default rate on high-quality commercial mortgage bonds is 8.7%, nearly triple the rate from 2 years ago. Market concentration is extreme. 7 stocks are holding up the entire S&P 500. If Nvidia, Apple, or Microsoft correct significantly, the market follows. This is not a broad, healthy rally. This is a narrow, fragile rally dependent on a handful of companies. We are not waiting for the crash window. We are eyeing the crash window. Right now, November 2025. The trigger could come at any moment. When the crash comes, here's what happens. Stocks will drop 65 to 80% from peak. This will be worse than 1929, which saw an 89% decline, and worse than 2008, which saw a 57% decline. Why worse? Because we have multiple bubbles bursting simultaneously and no policy response available. Bonds, for the first time in modern history, will not be a safe haven. Treasury yields will spike as confidence in government debt cracks. When the market realizes the U.S. government cannot service $36 trillion in debt, bond portfolios will lose 30 to 50%. This has never happened in a modern crash. In 1929 and 2008, bonds rallied as investors fled to safety. In 2025, there is no safety. Real estate will crater. Housing will decline 30 to 50%. Commercial real estate will decline 50 to 70%. Foreclosures will cascade through the system. Regional banks, already exposed to commercial real estate, will fail in waves. This triggers a credit freeze as banks stop lending entirely. Unemployment will spike to 15 to 20%, worse than 2008's 10% peak. Why? Because the crash is happening across all sectors simultaneously. When stocks, bonds, and real estate crash together, businesses fail, banks stop lending, consumers stop spending, and the entire economy seizes. Here's the cascade. Stock crash triggers margin calls. Margin calls trigger forced selling. Forced selling triggers bank stress. Bank stress triggers credit freeze. Credit freeze triggers business failures. Business failures trigger unemployment. Unemployment triggers housing defaults. Housing defaults trigger bank failures. Bank failures trigger government bailout attempts. But the government is already the biggest debtor at $36 trillion. Bailout attempts trigger debt crisis. Debt crisis triggers currency crisis. Currency crisis triggers systemic collapse. The recovery timeline will be brutal. After 1929, it took 25 years for the market to recover to its pre-crash level. After 2008, it took 6 years. After 2025, recovery could take even longer. Why? Because there are no policy tools available. Demographic headwinds with baby boomers retiring means sustained selling pressure, and global fragmentation means no international rescue. The Federal Reserve is trapped in a policy trilemma with no good options. Let me show you why every path leads to disaster. Option 1. Raise rates to fight inflation. The result? This crashes housing immediately because mortgages become unaffordable. It crashes commercial real estate because refinancing becomes impossible. It crashes corporations with variable debt because interest payments become unpayable. Regional banks exposed to real estate fail instantly. Recession is guaranteed. The math is simple. You cannot raise rates when the economy is leveraged to the maximum without triggering collapse. Option 2. Cut rates to stimulate the economy. The result? Inflation returns immediately. We saw this from 2021 to 2023. The Fed held rates near zero and inflation spiked to 9%, the highest in 40 years. If they cut rates aggressively now, inflation roars back. The dollar weakens on international markets. Imports become expensive. Food and energy prices spike. This creates stagflation, high inflation combined with recession, the worst possible outcome. Consumers get crushed by rising prices while losing their jobs. Option 3. Print money through quantitative easing. The result? We already know what happens. From 2020 to 2021, the Fed printed $5 trillion. The result was catastrophic inflation. The Fed has lost all credibility. If they print again, the dollar enters crisis. Foreign holders of U.S. debt, currently $7.7 trillion, will dump treasuries. Yields will spike. The cost to service the debt will explode. Do it again, and you risk destroying the dollar as the global reserve currency. There is no option 4. The government cannot bail out the system because the government is already the biggest debtor at $36 trillion. China won't help because they're in their own crisis with collapsing real estate and demographic decline. Europe won't help because they're dealing with energy crises and negative growth. The BRICS nations are creating alternative currencies specifically to escape dollar dependence. Unlike 2008, there's no cavalry coming. Unlike 1929, we see ain't cut rates from 5% to 0% because rates are already historically low and inflation limits cuts. We are out of moves. The Fed is trapped. The government is trapped. And the crash is inevitable. This isn't prediction. This is pattern recognition. The same patterns that preceded the 1929 crash are present now. Documented. The same patterns that preceded the 2008 crash are present now. Documented. Plus new patterns like the bond bubble and global fragmentation that make it worse. Every indicator is flashing red simultaneously. The yield curve uninverted in September 2024, putting us in the 3 to 12-month recession window. Consumer debt is at record highs with delinquencies rising. Insider selling is at panic levels with Buffett hoarding $334 billion in cash. Stock valuations are at the second highest level in history, with a P/E ratio of 30.42 and Buffett indicator at 209%. Commercial real estate defaults are accelerating with office vacancy at 19.6%. Policy tools are exhausted with the Fed unable to cut without reigniting inflation and unable to print without destroying the dollar. The timeline is clear. The recession window is December 2025 to September 2026. The trigger could come at any moment. It could be a major bank failure. It could be a sovereign debt crisis. It could be a geopolitical shock. It could be a derivatives blow-up in the $600 trillion market. The specific trigger doesn't matter. The system is so over-leveraged that any shock will cascade through the entire structure. This is not if. This is when. And when is measured in months, not years. We are closer to the crash than we are to safety. The question isn't whether the crash is coming. The crash is already locked in by the math. $36 trillion in debt at 5% interest rates is $1.8 trillion in annual interest payments. That's 38% of all tax revenue just for interest. You cannot sustain that. The question is, what are you doing about it? First, understand this is not normal volatility. This is systemic. This is not a correction. This is not a bear market. This is the convergence of three simultaneous bubbles with no policy tools to stop it. Understanding the magnitude is the first step. Second, prepare. I'm not giving financial advice. I'm giving you the data. Research historical safe havens during simultaneous crashes. Understand that traditional diversification, the classic 60-40 stocks and bonds portfolio, will not work when both stocks and bonds crash together. In 2008, bonds rallied and saved portfolios. In 2025, bonds will crash with stocks. Cash positions during crashes preserve capital for buying opportunities when assets are selling at massive discounts. Third, watch the indicators. Monitor the yield curve. Monitor consumer delinquency rates. Monitor commercial real estate defaults. Monitor insider selling. Monitor the Fed's balance sheet. When you see accelerating deterioration across multiple indicators simultaneously, that's your signal. When unemployment starts spiking, it's already too late. The crash happens fast. By the time it's obvious to everyone, the damage is done. Most importantly, don't believe that everything is fine narrative. In 2007, Fed Chairman Ben Bernanke said, subprime is contained. 6 months later, Bear Stearns collapsed. A year later, Lehman Brothers collapsed and the entire financial system nearly died. In 1929, economist Irving Fisher said, stocks have reached a permanently high plateau. Days later, the market crashed 89%. In 2025, they're saying the economy is strong. Inflation is under control. The Fed has this handled. History doesn't repeat, but it rhymes. And right now it's rhyming with two of the worst disasters in financial history. Simultaneously, the 1929 crash plus the 2008 crash plus a sovereign debt crisis that neither of those periods had. The math is clear. The timeline is narrow. The window is now. For those willing to see it, the warning signs are everywhere. The yield curve uninverted in September 2024. Buffett is hoarding record cash. Commercial real estate is collapsing. Government debt is at 125% of GDP. Interest payments are consuming 38% of tax revenue. The S&P 500 PE ratio is at 30.42. The Buffett indicator is at 209%, matching the 1929 peak. This is really happening. You need to act now. Here's your window. December 2025 to September 2026. That's the recession window based on historical patterns. The crash could happen any time within that window, or it could happen sooner if a major trigger event accelerates the timeline. What you do with this information is up to you, but you cannot say you weren't warned. The instruments that predicted every past crash are flashing red. All of them, simultaneously. This is not fear-mongering. This is reading the data. This is recognizing the pattern. This is understanding that when you combine 1929 level stock valuations with 2008 level real estate problems with a sovereign debt crisis that neither period had, you get something worse than both. The 2025 to 2030 collapse cycle is not coming. It's already here. The debt is already unsustainable. The bubbles are already inflated. The policy tools are already exhausted. All that's left is the trigger and the cascade. For those willing to see it, the time to prepare is not after the crash. The time to prepare is now.